said record production numbers were achieved in 10 operations and 3 commodities. Brait says net asset value increased 4.3% for the third quarter ended December 2013. The latest NAV reflects an increase of 23.1% for the 12 months ended December last year. South Africa's headline consumer inflation edged up to 5.4% year-on-year in December. This comes in slightly below market expectations from 5.3% in November. On a month-on-month basis, CPI quickened to 0.3%. Back to you, Studio.
Now, for a more in-depth look at the bond markets, we are joined in Cape Town by Mokgatla Madisha, Head of Fixed Income at Argon Asset Management. Mokgatla, thank you so much for making the time to talk to us this afternoon. Let's look at the major factors that are likely to determine what the outlook for the bond markets in 2014 and going forward are likely to be.
Well, is at the forefront of everybody's mind at the moment, particularly given what's happening on maize prices and the continued weakening of the rand. And then also, with tapering in the U.S., we've got U.S. Treasury is expected to go quite a bit higher than current levels, and that will be quite negative for bonds in general.
Mokgatla, let's unpack that, because you mentioned inflation there. We had CPI coming in below expectations. What type of impact will that have on the bond markets?
The number was good. I mean, it did surprise on the downside, as you said. Food particularly was a pleasant surprise, but it's a backward-looking number. Since December, maize prices are up about 30%, and we've had a few food producers come forward saying that they will have to pass on these prices to the consumer. So that's clearly something that's going to be a negative. And we also had a massive petrol price increase in January. Cents or so come February, so all of those are going to be negative. I think over the first half of the year, we will basically be watching to what extent that there will be some pass-through from the weak currency.
Mokgatla, of course, top of mind right now in South Africa is the impending strike, which is supposed to kick off tomorrow. What impact does this have on bond markets in the long term?
It's an indirect impact. So anything that affects output and demand for our commodities and therefore investment will be a negative. And so, the sooner it's resolved, the better for everybody. But it doesn't have a direct impact.
With regards to the FOMC, in about a week from now, we'll be getting more news coming out from that specific meeting. But in terms of the bond yields, what's the outlook on that? Because, when we had the busy pumping money in bond purchases, this is obviously positive. With regards to that, with saying that quantitative easing or tapering rather is being phased in fairly quickly, what's your view on what we can see by the end of the year?
U.S. growth has been pretty strong, so I wouldn't be surprised if, for example, the Fed decided to taper even quicker than the current plan. But at the same time, inflation has been very, very tame. So notwithstanding that the unemployment threshold, which is about to be reached now, I think bond yields will creep up only very slowly because inflation is still very supportive of current yields in the U.S.
Of course, Mokgatla, we've been talking to a large extent, looking at the negative impacts that the bond market is likely to face. What do you think would need to be done in order to improve the attractiveness of South Africa's bond market, given action it's going in terms of a rebounding of developed economies and the like?
Sure. Yeah, I mean, bond returns last year were pitiful. This year we're looking for sort of mid-single digit. So we think that the yields could rise a little bit, particularly if foreign investors continue to sell emerging markets in favor of developed markets. But having said that, it's a tale of two stories. The back end of the curve is very, very attractive. Yields there in real terms are about 3% odd. The front end can still take a little bit of pain, particularly if rates are increased in line with what the FRAs are pricing in. But the back end of the curve, I think, is where one should be investing at the moment.
Very quickly, Mokhatla, of course, that IMF Global Growth Report is out, and we're seeing that South Africa's growth forecast has been revised down, even though. Let's go back on how this will impact the attractiveness of South African bonds.
Well, it was quite a small adjustment from 2.9 to about 2.8. Because in the main, I don't think it really says much. What's more important is that we need to go from the 2.2 of last year to, closer to our potential growth rate. That's far more important, I think, in the medium term. How we get there is going to be quite a difficult task, however. And the impact on the bond market, as long as our growth is lower than our peers, we will struggle to attract capital, and that's the way it impacts the bond market.
Well, Mokhatla, thank you so much for that analysis with regards to the South African bond market. That was Mokhatla Madisha, who's the head of fixed income at Argon Asset Management. Goldman Sachs is expecting new listings in South Africa to jump for the first time in 3 years as private equity buyers sell investment. Well, that's according to Colin Coleman, who's the CEO of Goldman Sachs South Africa. As CNBC Africa anchor Bronwyn Nielsen spoke to Coleman at the World Economic Forum in Davos earlier today. She asked him what the biggest opportunities for Africa are going to be this year. Let's take a listen.
Well, look, I think it's a year of developed market growth and recovery. That's the theme. So Africa has to position itself as superior growth. Markets like Nigeria, I think, stand out. Mozambique, where there's this massive gas find and investments there. And South Africa is still the largest economy on the continent. So getting us to just do the basics right and perform and be efficient with what we have. South Africa is the only capital market that's deeply liquid and large. So for those wanting to play the African story, you really have to do it through the JSE if you want